All right, how's it going, everybody? My name is Antonio, and then luckily for you, I'm not the one doing the talking or the asking today. This will be a new segment on Research Talks that will be hosted by someone who actually knows what they're talking about. His name is Jordan. You might know him as Geologo Trader on Twitter. He also writes a Substack, by the way, under the same name, Geologo Trader. I'll link it somewhere so you can go check it out. He's an Aussie geologist, fancy degrees, experience in mining and exploration for almost a decade, yada yada yada. You get the deal. He's great. You should follow him on Twitter, read his Substack. But so he'll be talking to other geologists in this series, trying to decode the technical terms and pitfalls of the mineral exploration, development, and mining space, also known as the gambling space. Starting off with news releases in this episode, how do you read them? Why do they matter? Why do you even want to read them? What do you look for? And how do you not get your money stolen by tricks and treats? Stuff like that. That's the goal of it all. And in this specific episode, Jordan spoke to a geologist who currently works in the exploration space. He dabbles in the Twitter sphere as well as Bogan geologist, and they talk about understanding drill results, different methods of drilling, technical reports, and much more. So I'll be shutting him now, and we can hear from Jordan and Bogan.
With drilling, I think it's super important for investors to know the different methods of drilling, especially in mineral exploration. That they range considerably, and that can affect assay results hugely. So I'm going to leave this for another segment, but roughly the three main types we use in mineral exploration are air core drilling, reverse circulation drilling, and diamond drilling. And they range through different expenses, so different cost levels. So air core drilling being the most cheapest, and diamond drilling being the most expensive. So a lot of first pass exploration is done with air core drilling, the cheapest method, but that can really affect assay results, as smearing is very common with air core drilling because you're drilling through a lot of clays, and that's the only time when air core drilling is effective is when you have soft rock or clay. So that does affect the results. That can affect the results you see in releases, and you have to be able to spot that, because I don't know about you, Bogan, but I've seen some very dodgy results returned from air core drilling before, where clays get stuck up in the cyclone, which needs to be cleaned basically after they drill every rod, and that can cause some smearing to occur for the samples. So I've had some experience with that working in the goldfields of Australia before, where that's been the case. And you're never supposed to report it, but if you're a junior company and you're getting some really good results, it's going to be hard to determine where they're sort of coming from if you have this going on. So they either need to resample these samples, which are little piles on the ground, or just figure out what could be the potential cause of that smearing through the geology. Have you had any experience with that in your exploration time, mate?
I've had cases of smearing, mate. I've had cases of a drill bit blowing up and getting elevated results of different metals, very high silver grades, for instance, in a deposit that is primarily a gold deposit. There's a lot of things that can go wrong. And really, at the end of the day, it's not up to the investor to really catch those sort of things out, but they can arm themselves with a few little tricks that'll help their intuition. Number one, obviously, I'd say when you have isolated results that don't make sense, maybe start asking a couple of questions. When you're looking at a particular type of geology, and you can cross-reference that type of geology to other companies that are looking at similar style deposits, you can also ask some questions about, hey, why do we have these elevated results in this area? And then, as you were saying, there is the active smearing of the sample within cyclone, within even the rods themselves or the drill bit that may happen. Or there's the case of a company actually hitting a nugget of gold and smearing that over the entire drill hole. And so it's always a good idea to calculate the residual grade of drill holes. So if you see an intercept, say 100 meters at 1 gram per ton, including this for gold, for instance, including 1 meter at 98 grams per ton, you can infer that the 99 meters has a very low grade. And when a company is out doing initial first pass exploration holes, or even some later stage drill holes, they're not always reporting assays to a cutoff grade as much as they should be. And I think even the JORC guidelines actually state that you have to report drill results to these guidelines. Company
I'll stop you there, Mike. What's the JORC code, for instance? So can you explain a little bit of that? That's an Australian reference, but there are similar there is a similar code in Canada and other parts of the world. But what is the JORC reference for everybody to understand?
So the JORC code essentially exists as more of I'd say it is almost a law within geology, but a lot of companies just treat it as rough guidelines that is laid down by the government institutions that essentially govern our field within Australia. And they outline anything from essentially explaining exploration techniques, highlighting certain parts of the data and making sure that everything in a release, everything has to be there in a release for a person to make a proper decision over the company that they're looking at. And this goes all the way from basic exploration and even ground geophysical surveys, aeromag, stuff like that, soil sampling, rock sampling, all the way through to resource estimation and eventual mining parameters that get put around a resource, i.e. a reserve. And this code, I don't think it has been too powerful in itself, but it is a second rendition of an earlier, so it's the JORC 2012 code that we're currently governed by, but there's an earlier JORC 2004 code. And these codes are created after a series of fraudulent behaviours were reported, i.e. the BRIEX scandal, I think, was the one that led to the inception of the JORC 2004 code.
Yeah, okay, that's interesting. It sounds like it may have come from that. I don't know for sure, but yeah, it has to be something that's policed very closely. Otherwise, companies can basically release whatever they want to the market without any sort of reference or fact checking or anything to go by. They can just release whatever, and then investors can see huge numbers, and it's basically to protect them from just throwing all their money into these huge numbers that when there's no real reference to how that data has come about or assays have come about. So it's a very important aspect of exploration, and it's interesting, Bogan, that you say that it's not super effective. What do you think that may be?
Well, number one, companies generally put the JORC code tables at the bottom of releases, and investors generally like to read page one, and they don't really go much further than page one in a lot of releases. And even in a release that they've reread a couple of times, they won't go down to the JORC code table, which is generally in like a 7-point font for the most part, and individually read. So I think primarily it's the lack of visibility within each release of the way the company has answered the questions within the code. And it almost acts as like a sort of first barrier. It's the condom contraception of mineral exploration. And if you're not going to go to the lengths of reading that table at the bottom, well, don't be surprised if you go out and catch yourself exploration STI. Another reason I find that the code doesn't have teeth is because the institutions that govern our industry don't particularly care too much about bad behavior, and they don't punish bad behavior. And so thus, this unpunished bad behavior can continue to go on. You'll have companies that will forget to or completely screw up the GPS location points of drill holes, for instance. And so when an investor goes to have a look at what the spacing between those holes are, they have no idea that, hey, maybe these holes are all drilled from the exact same point. Yeah, there's a range of other reasons why I think the code can have more slack. But I think the biggest one that I'd like to see is the AusIMM, so Australian Institute of Mining and Metallurgy, and the other groups that govern the code. I'd like to see them act a little bit more, have a legal arm come in and basically bar operators from ever practicing geology again if they do the wrong thing, say 4 or 5 times. That'd be gnarly. But honestly, we're not at the stage that a lot of other professions are, and I think that's because geology in itself is quite a young science. So yeah, that really sums it up for me. I know the Canadians have their own version of the JORC code, and it acts in a slightly different way, has different structure on it. But yeah, for me, the JORC code is essentially the Bible of our profession in Australia. And yeah, you really have to pay homage to it and respect it, especially as an investor.
How would you interpret a release as soon as it comes out with the numbers? What are the first things you would look for on those releases, being a geologist? As an exploration geologist, what are the very first things you would pick apart on that release?
First thing, always, I want to see those results in 2D space, 3D space if possible. So that means plan section, i.e. looking down from the top, long section, so the pierce points of each individual drill hole and in the deposit prospect, and a cross section showing it going down essentially the third dimension. So looking along the deposit. And within those diagrams, the most important part, as always, is the scale bar. So the spacing between each of those drill hole intercepts will ultimately tell you what the size of the inferred resource might look like. So that's the number one. Is I'm always scrolling down straight away, trying to find those 2D images, trying to make the 3D model in my mind of what does this look like. And so the numbers always very important to know what the grade is, but I'm assuming you're talking about something that has actually caught my eye. And there are many releases that get released on a daily basis that I'll look at, immediately flick through, flick off. And then one of the next most important parts is, so obviously the depth, you'll be able to infer the depth of each of those pierce points by the scale bar itself. If not, they're already writing where the drill hole down hole has intercepted that assay result. But you, as some of you may be aware, those who are not aware, most of these drill holes, especially in the hard rock, gold and base metal space, are drilled at an angle, so i.e. dip angle. So a downhole intercept of, say, 300 meters downhole, you're looking at something, if it was drilled at, say, a 60-degree dip, that might be just around 200 meters of vertical depth from surface. And so immediately you've got that. And then on those 2D diagrams, they should have a range of other characteristics. So they should have the base of complete oxidation and the top of fresh rock, and that'll tell you where those drill intercepts are actually situated in, whether they're in the oxidized material, whether in regolith or transitional material.
With base of oxidation, this is a very Australia specific term for many people who are investors on this channel, I think, because We have this thing, it's a geology term. It's called a regolith in Australia, and basically it's to do with how old our rocks are and how much they've been weathered. They basically turn into clay, and that affects the mineralization. It's not just usually one big tabular body that you see in fresh rock. In the clay, because of the weathering, these deposits, the minerals of these deposits, the mineralization tends to scatter through the clay mineralization, which is not necessarily uniform, except at these weathering boundaries, which you just brought up, which is a base of complete oxidation. So this is getting quite technical, but it's something you will note in especially Western Australia and probably Queensland as well, I'd imagine. But if you're drilling in Canada, these don't typically exist like they do in Australia. So this is a completely it's really an Australian related thing, and West Africa, as far as I know. But it's getting quite technical. But it basically, the regolith and the clay mineralization is completely different to how it is below in the fresh rock because of these weathering processes. And that is where the base of complete oxidation comes in, which you just mentioned, right?
Yep. And so the effect that you're talking about, the supergene effect, it kind of does play a very important part in especially the WA based Archean gold deposits, just because you do have that concentration of the heavier minerals, i.e. gold, sitting at that boundary. But being able to understand these different zones and why they're important can also show you a little bit more about what's going on. You might have a different type of rock above the rock layer that you're looking for. You might have a zone of transported material from ancient fluvial or essentially fluvial activity, water transporting sediments down ancient creeks, rivers, floodplains, etc., depositing that material there and covering up those rock bodies. I'll say it's a very important thing, but you've got to really be able to look through those results and try and sort of pinpoint things. So if you see a very high grade gold zone on a boundary like that, try and, I don't know, think a little bit as to why that might be there. And it's always a good idea to sort of take a step back and try and understand what supergene processes how they work.
More often than not, with this supergene mineralization we're talking about, a lot of times, in my experience, that supergene mineralization hasn't been fully represented in the fresh rock below. So that supergene mineralization has to come from a source deeper. And quite often, once you drill into that deeper source where you expect considerable mineralization to exist, it doesn't. And that's because the supergene mineralization has effectively upgraded that fresh mineralization in the deeper rock. And it kind of gives it a false sense that there might be more mineralization deeper, considerably more than what we're seeing in the clay and in the supergene. But more often than not, that's not the actual case. I don't know if you've had any experience with that, but a lot of orogenic gold deposits are like that in Western Australia.
I'm pretty lucky in the fact that the one area in Western Australia that I have worked, we were basically, we're pretty good with supergene enrichment. We'd had a couple of spikes here and there, but for the most part, it was pretty tame. And the deposit itself is quite a skinny, high grade deposit. So when you have these skinnier vein style deposits, they only tend to really concentrate in one area, i.e. where the expression of the vein to surface is going. But when you're getting these larger bulk mining style deposits, that's when you tend to get more of a lateral enrichment. But I'll also say that this supergene enrichment, it's not necessarily a bad thing. There's a lot of really great gold mines that have been started by supergene enrichment. There's a company that recently got bought out in WA, Musgrave. They have a really, really, really nice supergene layer on top of what looks to be a pretty average gold deposit. But that supergene carries a ridiculous grade on it, and being not in the fresh rock area, it's amenable to easy open cut mining, doesn't really require too much blasting and stuff. So these different types of mining techniques or different types of mining styles really do play a part as well. But yeah, honestly, to really continue down the line though of what I look for in an announcement. So these 2D diagrams, really important. Don't forget your scale bar. Don't forget your weathering boundaries, different like rock types. But you also want to look for how previously inferred or previously drilled mineralization is situated compared to the drill hole intercept. And there's a classic term that we use in Australia called a director's special, where a drill hole gets drilled essentially at an oblique angle through a known rock body. Sometimes this is for a perfectly reasonable purpose. Sometimes the company has simply gotten the azimuth direction wrong when they're setting up a drill hole, in the recent case of Wildcat. But yeah, honestly, when you're looking at drilling into a mineral deposit, you want to try and hit that at basically a perpendicular angle, try and get a true width estimation of each drill hit, because that'll ultimately play into the way you calculate your resource later on, and it won't deceive investors. And so always look out to see if, hey, you've got a bunch of single digit at single gram per ton intercepts in a gold deposit, for example, and then you have one that's 200 meters at single gram per ton intercepts, and you could probably infer. The easiest way is to just look. All companies should have a table further down, usually be page 5, 6, 7, 8 onwards, of each drill hole. Via its drill hole ID, you'll have a GPS location. You'll have a dip, which is the angle that they've drilled the hole at. You'll have an azimuth. Just think of a compass, 0 to 360, which way the drill hole is facing. And then you'll have meters from the meters to the interval of what they've drilled, the grams per ton, and any other elements, be them potentially polymetallic elements in a lead zinc deposit, or deleterious elements in an iron ore deposit, for instance.
I just want to highlight how important that point is you made of looking at the results in a 2D cross section, which is a 2D diagram of how visually the drill holes situate. And it is so important to make sure that that drill hole is intersecting the ore body as close as you can to perpendicular. And these will always be in results released by companies, even if they're at later stage exploration, even if they're at the resource stage, even if they're their first pass. It's geologists' job to interpret how the drill hole has intersected the ore body, or the results that are being returned in the release. So just a visual on the cross-section is very important to make sure that it is as close to perpendicular as it can. Now, this, as Bogan said, this is not always as easy as it sounds, but it's one thing you should check out straight away when these releases are released. It's one of the first things you should check, in my view.
And this is definitely one of the, so going back to the fact that there's multiple drill rig types that you drill with, this is where diamond drilling really comes into its own in the structural data you get of contacts, faulting, basically the contacts between different rock bodies, faulting that may or may not have happened in the area, vein directions, and the way they go through the core samples. And so these are generally measured with a tool called a chronometer. You can look it up yourself, KENO meter. And when you're drilling with RC or air core, half the time you don't have any idea until you've got multiple holes into a prospect or a deposit what way everything's going. But when you're drilling with diamond and you start hitting stuff, that's when the whole picture becomes available to you as a geologist logging at the company. And it's on you or your exploration manager to present that to the public in the most crystal clear, transparent way. And so, but I'd say really on the whole, and I will say there's a bunch of other reasons why diamond drilling is as expensive and as important as it is. But back to the subject matter, on the whole, an investor being able to understand these few things, so these cross sections, long sections, and the plan view sections, and what these tables mean down the bottom, the JORC table and the drill hole intercept table, you can really start to give yourself a head start on being able to understand how everything works with a particular prospect, particular deposit, particular company. And that's when you start making blacklists. It's when you start adding companies that do the wrong thing to a blacklist. And yeah, from there, you'll already be a couple of steps ahead.
That's a very good summary, mate. That's almost the perfect steps of what to look for in a release right there. So very valuable information, I think. Let's go on to just another technical term that I'll get you to briefly explain, mate. So what's the difference between indicated and inferred resources, and how should investors interpret them?
Confidence, confidence, confidence. And that's what it gives you, confidence. So an inferred resource, depending on what type of deposit you're drilling into. So we'll go back to the one that we've been using quite consistently, gold. Just think narrow vein, Archean, lode style gold. You're really looking with an inferred resource at a fairly wide spacing. So imagine, say, 50 meters in between drill holes on a grid into the deposit. When you're looking at an indicated... Sorry?
No, go on, mate. Sorry, I'll come in after with something, but yeah, keep going.
When you're looking at an indicated resource of that nature and that type, you're really looking at that drill spacing as being condensed. And one of the things that might happen is that you might have drill holes that'll deviate and go off course and start grouping. But on the whole, you're looking at the pierce points within that long section that we talked about previously, essentially being filled in at almost 25 to 20 meter spacing between holes. And so you're able to get that extra data. You're able to basically get a much more accurate assumption on the grades between those holes. And from there, the confidence level increases. And this is why investors should always be happy that companies are going back and doing infill drilling into a prospect that they're taking from an inferred resource to an indicated resource, because it ultimately gives you better confidence as an investor that when a company plans on going and wrapping mining parameters around that deposit, that they're not going to start hitting blank zones within the deposit that an effect called the nugget effect that happens
it's
in
basically
deposits.
The more drilling you have on a resource, the more confidence in that resource model. So it's by the time you come to mining that resource, you're not going to get any surprises in the geology where once you start digging it up and putting it through the mill, that grade that you thought was there, if it wasn't there, then that could be a product of inconsistencies in your resource model due to you not defining the resource properly. So it's basically the more drilling you have into an ore body and a resource, the more confidence you're going to have behind it so that what you've predicted is there in the ground is actually going to be there.
That's exactly it. And when this drilling is being conducted, especially when you're moving from an inferred resource to an indicated resource, those extra drill holes primarily will also give you extra samples. Those extra samples going off the assay, that's one thing. But companies will also generally put a couple of diamond holes in each line to be able to generate metallurgical samples and to be able to submit those samples to the lab to do metallurgy tests to work out what their recoveries are going to be via a specific type of processing route. And when you can start getting confidence within the metallurgical parameters of a deposit, and this is where that whole the base of complete oxidation and the top of fresh rock come back in, you can start defining the boundaries of the domains of your deposit. So where's your fresh rock? Where's your transitional domain? Where's your oxide domain? How are those domains going to be processed? How will they process in the route that you're going to use, i.e. cyanide in leach, cyanide in pulp, CIL or CEIP? Or is your deposit primarily oxide and the fresh rock zone, is it shit? And do you want to just heap leach it as a oxide primary oxide deposit? This has been important. This has been highlighted recently with Chalice Mining, a company that's found a nickel, copper, cobalt, platinum, palladium, gold, yada 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 polymetallic deposit, and they have an oxide zone within it that essentially is unprocessable, via what the African companies that have been mining these platinum, palladium oxide zones previously have tried. They can't crack the code, so there's no reason why this Chalice company will be able to crack the code. But when you're defining the resource, when you're moving it from inferred to indicated, when you're taking it to that next level and putting a reserve parameter, so economically confident mining parameters depending on your style of mining that you're going to do, so block cave, sub-level cave, long hole open stope. When you're putting these mining parameters around the deposit, you can actually work out, okay, we're going to be taking this much ore out of this area. It's going through the mill via this processing route with these recovery parameters. In the case of base metal concentrates, you're looking at payability parameters as well, how much the smelter is going to charge you for processing the concentrate of your copper or of your zinc or lead. And this feeds into these things that we call feasibility, pre-feasibility, or scoping studies in Australia, or PEAs, I think the Canadians talk about always, preliminary economic assessment. But all of these factors are so important, and this inferred to indicated step is where you should start gaining this confidence. And I love using the term of confidence in it applies to so many factors. It has such a double, triple, quadruple meaning within this topic. And so really you've got to look at something. Say you're buying a company that's got a deposit that they're building a processing plant for, that they haven't released a reserve. They have got 70% of the resource in the inferred category. You start asking questions. You start really asking questions about, hey, is this actually going to be feasible? Are they going to get to an area and realize that, oh no, we've got a dolerite dike in this area that we haven't worked out that was there, and suddenly everything goes to shit. Their whole model is off. They miss 2 months, 3 months of processing decent grade ore. Their recoveries go to shit. Their debt lender comes knocking on the door saying, hey, you're supposed to be delivering into your hedge book or paying me back the money that I lent you. And then the whole thing crashes and burns.
Oh man, these can be super fiddly, these resource models. They're not as black and white as they may sound. There can be a range of geological surprises not picked up in these deposits and resources that you just really don't know about until you get down to a level which isn't covered from drill spacing. There's only a certain amount of holes you can plug into these things before they become uneconomic. And if you do have areas of question in your resource model, yes, the geologist's job is to focus on them and to really nut them out, plan a few extra drill holes. But sometimes, in my experience, there can just be complete surprises which can really affect production once you come to mining that stage. And that's just something that is just part of mining. But you do really need to do your own research into these companies if you're an investor, just basically to make sure that what they're saying is legit from your point of view. You need to basically fact check them and go through a lot of the procedures that Bogan's talked about in this talk. I think it's very very helpful for people to listen to this and to understand what to look for when these companies are reporting assay results.
That's entirely it, mate. Yeah. And one of the things I'd say when it comes to really reading through these reports, you always have to sit back and think, okay, what are they telling me? What are they trying to tell me? And reading through the language of how a company presents something, you can honestly, you get to a stage where you get a sixth sense that something bad is going on. And it might take you a couple of years to get there with reading these releases. But not investment advice, I'll say, but really don't put all your eggs in one basket if you're unsure of something. And even if you're sure of something and you're just learning and you're at that beginning stage, still don't put all your eggs in one basket. And don't be afraid to reach out and talk to the company. Don't be afraid to reach out and talk to a geologist you might know or someone that understands these companies. My DMs are always open on Twitter, as much as I might suck at replying to some of them, and I apologize to people if I haven't replied to you previously, but find a way of arming yourself with knowledge, because knowledge is power in these situations. And when you're able to read through things as a person that's read through hundreds of releases, thousands of releases, you will find one release one day that knocks your socks off, that you can't find anything wrong with, that you'll be able to go through, you'll be able to fact check it, you'll double read it, you'll triple read it, you'll get a warm, gooey feeling in your stomach, and then you'll put your money in it, and the rest will be history. And these discoveries do come along, and really it's if as I said earlier, go back and read what happens and have a look at a price chart of, say, I don't know, Serious Resources or maybe even De Grey is a pretty good one for companies, and understand that, okay, well, when one of these things happens, you going through reading hundreds of crappy news releases from crappy companies that are going to go nowhere, you've suddenly found something, you're able to read these Egyptian hieroglyphics and you're able to understand it. That's where people make money in this sector. It's from being able to trudge through all this shit to find one gold nugget lying in the field. And honestly, if people want to really do the work. Don't be surprised if, hey, might take 2-3 years for it to pay off, but when it does pay off, you'll be thanking yourself later. You'll be thanking yourself for waking up and reading ASX releases and getting bored and, reading tables of data and 7-point font fucking
Very good.
JORC tables.
Very good point, mate. Very good point. If you can teach yourself some basic geology and learn about how basic exploration works for mineral exploration, then that is doing yourself a huge favor if you want to invest in the sector. Don't just go into these releases, look at the numbers and have no idea what they mean because everybody's jumping on board. Do the research yourself. Go through the steps that we've talked about today in this chat. And I think you'll be much better off if you want to invest in the space. Bogan, do you have any companies that you're particularly interested in at the moment at an exploration stage?
Yeah, I do have one. Ding, 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 I do own it. I've basically owned it since they released drill results back in May, and gave me that warm, gooey feeling as I was hightailing it across the eastern part of WA. But it's called WA1 Resources, and they essentially hit a niobium deposit in the middle of essentially the Australian desert. People can familiarise themselves with niobium, but essentially it's all 90% mined in one deposit in Brazil. And essentially they've drilled a hole. It's hit an oxide blanket of this super enriched dirt it's got niobium in it. And they've drilled these holes on 200-meter step outs. As I said, scale bars, long sections, plan view sections. Very important for understanding this sort of stuff, being able to read it, being able to execute immediately on it. It's hosted in an oxide zone, so it's free dig material. So as I said, there's benefits and there's also downfalls of having mineralization in oxide or transitional or fresh boundaries zones. So being able to understand those is quite important. And from there, from that one fateful day, really the company's just been going through and Swiss cheesing this imprint of a carbonatite, so a intrusive that hosts most of the rare earth metal deposits around the globe. The people listening can probably go familiarise themselves with Mount Weld, Linus's deposit, or one of the other few deposits around the world that produce rare earth metals or niobium. In the case of Araja or Katala, I think is one of them, or Niobek in Canada. Really knock the socks off. I think the company's going to do grand things if the deposit doesn't get bought out before its time. The big question that we're still waiting to have answered is that metallurgy question, but they're working on it. They've put together a brilliant technical team. They've been really disciplined with the way they've drilled out the deposit. People should familiarise themselves with that story. I'm not saying to go and, mortgage a house for it, but at least have a look at the story and see how the company's conducted themselves along the way. They've added another drill rig on, a diamond drill rig, to get those different types of results. They've started a massive metallurgy campaign. They've done infill spacing, which they've just released the results of. They only need to have 100-meter spacing to be able to get to that indicated stage of resource. And this methodology that we've been talking about, Jordan, it applies to really any different type of mineral discovery that gets made. And once you're able to spot something within a gold setting, you can easily transfer that knowledge over to a different type of commodity. you might have to make a couple of adjustments along the way. You might have to learn a little bit more, but really, learning should be your number one priority before you're going to make money. Learn to walk before you can run.
Oh, mate, exactly what you said. It's sorry, mate. The evolution is very similar between all of these commodities we're talking about. Maybe a bit different for oil and gas, but through minerals and metals and just commodities, it's the evolution is almost exactly the same. So WA1 is a great example because I remember like just a year ago, they're trading at something like 20 cents a share, right, Bogan? And now I think they're up around $10 a share or something. So that's been an incredible story. And this is highly speculative stuff, this sector. So these stories are very worth keeping an eye on. And yeah, exactly what Bogan said, backtrack on how the evolution of that deposit and discovery is panning out.
That's it, mate. That's it. And you've really got to remember this is still gambling, really. It's everything from the geologist planning a hole over a speculative prospect for his company that people have invested in for an IPO or as a private company, all the way through to a person taking a punt on a stock, all the way through to a person putting money into BHP or here, for instance, Keck, thinking that something's going to happen with this Glencore takeover deal. Everything to do with minerals and mining is a gamble of some description. Gambling, there's nothing. Well, there's plenty of things that are bad about it. There's plenty of things that are good about it. It's a natural thing for humans. We gambled once upon a time with a spark, and that created a fire that took us out of the caves. Once upon a time.
It's so true. It's so true. With one thing I want to say is geologists aren't market experts either. So I think Bogan has a background in assessing companies financially. That is not normal for geologists, especially exploration geologists. They can deal with a basic budget, but they don't know how the market is going to respond. No, neither does anybody. But I haven't met too many rich geologists through investing in my time in the industry. So I just want to make that very clear. Geologists are very pigeonholed with this stuff, and they're not always market experts on the financial side of things. So yeah, if you do combine those two skills together, I think it's very powerful. And I think Bogan's one of those rare ones.
Thanks, mate. Thanks. But yeah, I'll say I did have a bit of an experience as a commodities analyst once upon a time, past life. But on the whole, it's just as easy for a person to come from the finance side and learn technology. And I would say to people that aren't familiar with either of the two sciences, finance is a science. We all know that. Really, it's not too hard to familiarize yourself with what you need for both of them. But just go out there and really cover yourself, cover your bases with everything you can, learn as much as you can, keep reading, read into old discoveries, read into old stock frauds, watch that movie Gold with Matthew McConaughey, whatever his name is. Familiarize yourself with every part of how this works, and don't be afraid to go out there and risk a little bit, but just do it in a sensible way. Just take the safest bet you can, and honestly, learn how the big guys play it, but don't read too much into everything they do. The big companies out there, well, apart from the old Western Mining Corp guys, most of the big guys suck at finding new mineral discoveries. I can't think of anyone that's really found anything major since Winu by Rio Tinto back in the day, and Winu still seems to be under the dirt. These companies aren't geared for exploration because, quite frankly, they don't have a risk-tolerant culture within them. They're very risk-averse. They'll send out geo teams with basically a set plan and really to deviate from that set plan is to kind of court disaster for those geos in their young and budding careers. But
Mate,
really, you've got to
I have exactly experience in this. I went from a junior miner to mid-tier miner into a major, and the difference in the exploration teams is huge. The intensity is just very different in the majors. It's a completely different game to if you're trying to find something with a limited budget in junior mining. Yeah, that's all I'll say on that. But it's a very good point that the major companies in the world aren't actively, they're actively out there exploring, but the intensity is just so different to the juniors and even the mid tiers. So it's something to note if you want to invest in the space.
And dude, this is like a perfect time to say it to them. Like honestly, like BHP, Rio, Fortescue, fucking Sandfire, man. Like Sandfire, you went out and found DeGrussa. Like, come on, pick up your game. And to the people listening to this, really, like, unless you found a person, a management team, a geologist who works for him that is absolutely crazy about what he does or she does, that loves rocks, that loves drilling holes in the ground, that has the dream of finding a discovery that is going to make their life worth living. Don't go and blindly put your money behind someone. People are in this game mostly to make money and to earn their wage. You really need to get behind geologists that are passionate about what they do. I'm lucky I've had some brilliant geologists that have worked around me. I've had a mentor that's absolutely gaga about being a geologist, and he's one of the most fulfilled and lovely blokes you'll ever meet in your life. And then I've worked around geologists that, well, quite frankly, couldn't give a fig about what they were doing. They'd be happy to go and scrub toilets for the exact same amount of remuneration, except scrubbing toilets doesn't give them that money.
Mate, that's a great point. And these days, you can literally vet geologists by just banging their name in on LinkedIn and searching where they've worked. Like, it's that easy these days. If they don't have if they're running a company, if they're a geologist on the board, what is his work history? Has he been involved in a discovery? Is he competent? Quite often you'll see just these guys filling positions on the board. But the beauty these days is you can literally vet this. You can go on LinkedIn, you can search, you can see where they've worked, you can see their discovery history. And more often than not, it would just be in the media to be an old article or something about a discovery, or they'll be known through somewhere on the internet. So it's the beauty about these days. If you are investing in these companies, do your background research on the people running the company, especially the geologists.
That's it, mate. That's it. Honestly, and don't be too put off by someone that's moved from company to company year after year after year, because really, geologists, we're always looking for the next discovery. We get bored easily by shit prospects. We get bored easily by shit companies. The cultures in a lot of these companies that exist there's no culture within some of these companies. A lot of them use contract hired geos that have no passion for the project that they're working on. A lot of projects that companies are working on, the initial drill holes that made the discoveries that they might be trying to follow up weren't made by them. They were made by some other company that has sold those tenements on or has crashed and burned and died during a past mining bust. And really, you need to look at these companies, look at the people that are behind them. And, hey, you might find that there is a guy that's got no track record, but he has a love and a passion for what he does, and he's out there looking at the same bit of land for a year, 2 years, 3 years, trying to put it together. He knows there's something there, and sometimes these guys have success. But as you were saying, really, success breeds success. And when you have a good team that has made these discoveries before, don't be surprised if they just turn around and make another discovery and another discovery and another discovery, because ultimately that's what we're trained to do. And as a good racehorse wins race after race after race, a good discovery team makes discovery after discovery after discovery.